Wait before getting that electric car. Something big is happening in the EV world. Car makers spilled the beans on a shocking update, revealing a dark side to the EV scene. It is all about a massive EV market crash, a disaster that might hit not just EV owners, but everyone. Think you're in the loop? Think again. In this video, we're digging into the story unfolding in the electric vehicle market. A surge in EV production hit a snag, leading to a crisis with thousands of unsold EVs piling up. Major car manufacturers are pumping $616 billion into EVs by 2030, but things took an unexpected turn. Join us as we uncover the nitty-gritty of this alarming situation that's keeping car makers on their toes. Don't skip this. Stick around to discover what's really going on with the massive EV market crash. Whether you're an EV fan or just curious, understanding the fallout from this crisis is crucial. It's not just about electric cars. The impact ripples through the whole car scene. You might think you're safe, but the truth is, this crash could have surprises for everyone. The imminent occurrence is a notable downturn in the electric vehicle market, forecasting a potential 50% reduction in prices. Current conditions advise against acquiring a new or used EV. Major industry players, including Ford, GM, and Tesla, who collectively invested billions in EV production, are witnessing a decline in consumer interest. In the United States, EV sales have decelerated, with the time required to sell an EV doubling since the preceding November. Despite the prevailing perception that EVs represent the future replacement for combustion engines, reservations persist due to elevated costs and limited range, particularly in entry-level models. Concerns such as range anxiety and insufficient public charging infrastructure contribute significantly to consumer hesitation, particularly for long-distance travel. However, a deeper undercurrent influences this shift, as China exerts a substantial yet unspoken influence on the American EV market through a strategy with potentially perilous ramifications. Market indicators underscore this subdued sentiment, as EVs linger on dealership lots for an extended period, ranging from 90 to 100 days, a stark contrast to the 52-day average observed for internal combustion engine vehicles in 2021. Consumer interest in EVs has waned from 86% to 67% by 2023. The pricing dynamics of EVs present an additional impediment, as they tend to be more expensive than their gasoline counterparts, with luxury EVs demonstrating greater resilience due to a less price-sensitive, affluent consumer base. Notably, even Tesla, a pioneering force in the EV market and the sole profitable U.S. car maker, has had to implement substantial price reductions, including a 30% reduction this year, to sustain sales volume. Elon Musk, CEO of Tesla, articulated concerns over the current high-interest rate environment impacting the monthly payments and, consequently, the purchasing decisions of potential car buyers. This sentiment resonates across the industry, as collectively, companies have committed approximately $100 billion in North America to produce electric cars targeting both luxury and mass-market segments. Yet, economic constraints are exerting pressure on the affordability of these vehicles. Illustratively, the Ford F-150 Lightning and General Motors Chevy Blazer, in their electric versions, witness substantial price differentials compared to their gasoline-powered counterparts. The inflated costs of EVs primarily stem from the expensive batteries propelling them. Projections from Bloomberg NEF Research suggest that it may take a minimum of 3 more years before EV battery prices align with those of internal combustion engines. Tesla's concerted effort to implement substantial price reductions has resulted in a notable contraction of automotive revenue growth, plummeting from 51% in the previous year to a mere 5% in the third quarter of the current fiscal year. Concurrently, the company's automotive gross margin experienced a decline, reaching 16.3% in the quarter, marking its lowest point in over 4 years. Faced with this challenging economic milieu, major automakers are reevaluating and postponing expansion plans. Elon Musk, Tesla's CEO, hinted at a potential deferment of a new $1 billion plant in Mexico. Similarly, General Motors has deferred its plans to expand electric pickup truck production in suburban Detroit, delaying the commencement date to late 2025 from the initially envisaged timeframe next year. Ford Motor Company is also recalibrating its strategic trajectory, deferring $1.22 billion of its planned $15 billion investments earmarked for electric vehicle-related initiatives. These strategic adjustments are discernible in the financial performance of major automakers. Ford's electric vehicle unit, designated as Model E, reported an operating loss of $1.3 billion in the last quarter, anticipating a cumulative loss of $4.5 billion on EVs for the fiscal year. Presently, Ford is selling EVs at a loss of nearly $36,000 per vehicle. This financial strain is exemplified by a significant decline in sales for the Mustang Mach-E, experiencing a month-over-month drop of 53% in October 2023. Despite previous successes in boosting Ford's sales records, the company is now reducing production of the Mach-E. Sales of the Mustang Mach-E declined to 2,732 units from a peak of 5,872 units in September, while Ford's overall EV sales registered a 12.6% increase through October, surpassing the growth of internal combustion vehicles at 6.8%. They fell short when compared to hybrid vehicle sales, which observed an 18.8% surge. Adapting to the evolving market dynamics, Ford introduced a new flash trim for the 2024 F-150 Lightning, offering a 320-mile range and a technology-laden interior for under $70,000. However, the elevated sticker price remains a pivotal factor in Ford's challenges. The decision to halt F-150 Lightning production, particularly after retooling the plant in Quanton to augment output, was unexpected. The F-150 Lightning had constituted over 70% of Ford's total EV sales in a record-setting third quarter. In tandem with the production cut, Ford is postponing significant EV-related investments, including the deferment of a second battery plant in Kentucky in collaboration with SK Innovation, contributing to an overall delay of approximately $1.22 billion in EV spending. General Motors is confronting comparable challenges, recently divulging setbacks in the production timelines for its Equinox, Silverado RST, and GMC Sierra Denali electric vehicles. The Orion Assembly Plant in suburban Detroit is now scheduled to commence the production of the Chevy Silverado and GMC Sierra EVs by the conclusion of 2022, marking a one-year postponement from the initial projection. GM rationalized this delay by citing the imperative to judiciously manage capital spending and align with the evolving demands within the EV sector. Simultaneously, executives at Mercedes-Benz have expressed reservations regarding the future trajectory of the EV market in recent statements. Prominent figures from GM, Ford, and Mercedes-Benz have underscored the formidable challenges prevalent in the EV sector. Ford CEO Jim Farley, in reflections during the company's third-quarter earnings call, underscored the intricacies of the EV market, articulating, "It has been a challenging situation for sure. People are not prepared to pay what we thought they would." Farley highlighted the prevailing reality that a superior product alone is insufficient, emphasizing the newfound criticality of competitive costs. Affordability emerges as a pivotal concern for consumers in the realm of EVs, with the average transaction price for vehicles in the U.S. reaching approximately $48,000 in September 2023, while EV prices ranged from $53,000 to $60,000. A significant revelation regarding the challenges faced by American automakers in selling EVs is the notable control exerted by China over nearly 80% of the global EV battery supply. While endeavors are underway in the United States to attain self-sufficiency in this domain, China's dominance remains a formidable impediment. China's influence was underscored by its role in causing the global semiconductor shortage in 2021, prompting extensive shortages amid heightened demand. Consequently, significant investments were made by car manufacturers in Chinese EV supplies. However, as these vehicles entered the market, disillusionment ensued, leading to a decline in consumer interest and subsequent price reductions. Bloomberg NEF reports a 13% drop in the average price of a battery electric vehicle in 2023, amounting to approximately $33,500, fueled by diminishing battery costs. Analysts caution against immediate car purchases, anticipating further price declines in the forthcoming months amidst the looming market correction. This paradigm shift, where consumers once paid premiums and faced prolonged waiting periods for new vehicles, especially EVs, has shifted dramatically. Analysts now advise potential buyers to exercise patience, suggesting that waiting until the second quarter of 2024 may yield significant cost savings. The road ahead for EV manufacturers is fraught with challenges, necessitating a delicate balance between affordability and profitability as automakers recalibrate their strategies in response to evolving market dynamics. The path of the EV industry will likely be shaped by economic factors as much as technological innovations. Given the current circumstances, opting for hybrids or traditional internal combustion vehicles may offer substantial cost savings and prudence amid the anticipated EV market correction. In addressing the current challenges, American automakers must strengthen their resilience amid a complex set of obstacles. Shifting consumer sentiments, influenced by economic factors, and technological advancements, require a strategic adjustment in the production and promotion of electric vehicles. As these challenges endure, the industry's trajectory hinges on effectively balancing cost efficiency with consumer affordability. The significant control exerted by China over the global EV battery supply emphasizes the need for strategic autonomy within the American automotive sector. Efforts to achieve self-sufficiency in battery production are crucial for reducing external dependencies. In the midst of the correction in the EV market, adopting a pragmatic approach and closely monitoring market dynamics is essential for both manufacturers and consumers. The path forward calls for careful planning and adaptability to the changing landscape of the electric vehicle industry. Thanks for watching this video. Please be sure to share your thoughts. See you in the next video.